In this video I'm going to show you how behavioral human biases can lead to suboptimal investment decisions and how important it is to invest systematically. So let's start with a thought experiment. Imagine you have a biased coin, one that has a 51% chance of getting heads and a 49% chance of getting tails. My question is, how much would you invest in each of 1,000 coin tosses? Now, in order to understand this, let's just rationalize what we could do. Maybe we should invest 100% in each coin toss. Let's say we have $1,000 to start with. So if we invest $1,000 in the first coin toss, we may win, we get a $2,000, and then we invest $2,000 in the next coin toss, and so on. Well, the problem is that after a whole number of heads, perhaps, that you throw, maybe 10, finally you will get the tails, and then it will wipe you out completely, so you will lose everything. It is very unlikely that you would get 1,000 heads in a row and win this game completely. So that's not a good idea. What about investing very small amount of money, like 0.0001%? The problem here is that you win, you lose, you win, you lose, and every time you win a tiny amount of money or you lose a tiny amount of money. But it would take a very long time before you actually accumulate anything, even though you have a slight edge. So we know that we have an edge in our favor. Now, what is the real solution here? And as so many times, the truth is somewhere in the middle. There is in fact a mathematical formulation that can tell us exactly where we need to be. And in this case, it is 2%. The mathematical formulation is called the Kelly formula. And it tells us that if we invest 2% of the money we have, so if we start with $1,000, we invest $20, we will optimize or maximize our win over the long run. Now, interesting here is that if we were to invest twice the amount, say 4%, we would mathematically be guaranteed to be wiped out in the long run. And then if we invest even more, we are really committing suicide. So why is that? Well, basically, as we invest or as we put money in every coin toss, our bankroll will go up and down. So we might lose 10 times. We could lose 200 or whatever, 100 something dollars. Or we lose 20 times, we lose even more. And we actually get quite a high variance of our bankroll. But in the long run, we will obviously make more and more money if we invest the optimal fraction. But if we invest too high, what will happen is our swings will become even larger. And at some point, we will just simply go down to zero. And then we will have nothing to invest anymore. So we want to avoid this. And this example is important because what you can see is that even with such a simple thing as a biased coin, it is actually quite complex and counterintuitive to think about how we should invest in each of those coin tosses. Now enter the stock market. The stock market is even more complex because it's got prices going up and down in small increments. And so because of that, we have an even smaller margin for error than in the coin toss. One other problem here is that the odds of which for which our stock prices go up and down, they are not exactly known. So we cannot be sure whether we have a 51% chance of a stock price going up or down. And that makes it even more difficult. So maybe because of this complexity, we should say, well, let's just trust our gut feeling and just go and just invest whatever we feel like is the right amount. After all, our brain is quite a complex system. Well, actually, that may be helpful sometimes for short-term decisions of quite simple systems that we understand really well. But for the long run, and if you trade quite big portfolios, gut feeling can actually be quite detrimental and inconsistent. And this has been shown in many studies. Here another graph that shows how difficult investing can actually be. Even God might get fired as an asset manager. Alpha Architect wrote a good paper on this. So what do we see here? We're basically building portfolios looking back 100 years, all the way down to the great financial crisis in 1929. Sorry, the Great Depression in 1929. And what we do is we take the top 10% performers for every 5-year period, and we invest in them 5 years prior to when they've performed at their peak. And what we can see is, even though we know what the top 10% performers are in each period, we end up sometimes with really large drawdowns up to 76%, such as down here in the Great Depression, or 40% here in the Great Financial Crisis, and 30-something%, almost 40% during the dot-com bubble. So these large losses would probably get most active managers fired from their jobs. And so if you were God and you could actually predict the stock price really well, it still doesn't guarantee that you would keep your job. And again, it shows how difficult it can be to make the right investment decisions. So the question is, can we do better than that? Well, perhaps not. Perhaps we cannot outperform the God portfolio, but we could still outperform the market. And we could do this at significantly lower risk. But in order to do that, we also need to understand the problems that could bias our behaviors as an investor. To understand this a little bit better, look at this chart. This shows how emotions influence investment decisions. And it shows the annual returns of the S&P 500 ETF, the SPY. And you can see at the beginning, this is just before the dot-com bubble burst, we have some really good returns. And you can also see on the line that during that time, investors were really euphoric and they poured more and more money in the S&P. And then the dot-com bubble crashes and we get 3 years of negative returns. You can see that investor inflows into that fund decline very rapidly. But then in 2003, suddenly we have a really strong recovery. But because investors were fearful and very cautious, many of them actually missed that recovery because they took their money out of the fund or they didn't invest anymore. And the same process happens also in 2008 during the GFC. A lot of investors actually missed the big recovery because of fear and because of very cautious investment strategies. Now, you could say, well, we still have some good years, so why would that be a problem? Let's have a look at the next chart. So what we're really saying is when we act on our emotions, we're trying to time the market. Now on the left, you see the bar where we actually invested in the S&P 500 20 years ago and we stayed the course. We never took our money out. We can see that overall our annual return is about 9.2%. Interestingly, for the next bar, if we only miss the best 10 days of this 20-year period, our return actually goes down to 5.5%. So that's a significant decrease in our annual return by only missing the best 10 days. If you miss the best 30 days, we're already down to 0.9% annually, less than 1%. And think about it, we've got about 7,000 days here, and all we did is miss the best 30. If we miss even more good days than that, let's say the best 90, we're actually returning a negative value of minus 8.6% annually. And this is really something that should get every investor to think really carefully about what their investment decisions should be. Now here's another one. Can you actually trust yourself at good timing? Because you could say, well, these are all the other investors and I'm much better than that. I really understand the market, I can read charts, I understand companies and so on. Now here's my question. There's two charts here. One of them is a real stock price and one of them is random. Take a moment to think about which one of these two could be the random one. It turns out the random chart is the one on the right. This chart is produced entirely with random numbers, and each new price movement that we see is completely composed of random numbers, and there is no reason why it would go one way or the other. Now interestingly, as we look at this chart, our human brain still can see quite a lot of features. It can see trend channels, head and shoulders patterns, tops, and all these fancy chart technician features that we can sometimes use to try to predict the stock market. But in fact, none of them has any validity because of the complete randomness of this chart. On the other side, we have a chart which is an actual stock chart. And so I would really ask you, would you have really picked one or the other correctly with certainty? I guess not. Interestingly, if we use a computer to statistically analyze the two charts, we can clearly see the difference between them. We can actually see that the chart on the left does have some interesting autocorrelations in it that give us much higher confidence that the left chart would be the non-random one. So, as you can see here, our human brain often tricks us into seeing patterns that are not actually there. Now here we come to modern systematic investing, which is basically a quantitative method to invest in a smarter way than perhaps we humans can easily derive from our own intuition. And Harry Markowitz is the father of modern portfolio theory. He gave us this good little quote: "Good portfolio is more than a long list of good stocks and bonds. It is a balanced whole, providing the investor with protections and opportunities with respect to a wide range of contingencies." So modern systematic investing is really separated into a few features that make it very interesting. The first one is diversification. We often try to diversify our portfolio a bit more, and Harry Markowitz himself actually said diversification is perhaps the only free lunch in investing. Secondly, rather than trying to predict the price movements of our stocks, we're trading on probabilities. We're determining the probabilities, and then we use those probabilities to make our decision, rather than trying to make any predictions. And then finally, we use sophisticated trade execution. Specifically in the last few years, trading technology has become a lot more elaborate, and there's some players, such as high-frequency firms, that sometimes can actually provide us with much worse execution than we would like, because they have the ability to sometimes front-run our trades. So having good trade execution can often save us those really important small increments of basis points that we need to be successful in the markets. So here we have quant funds. Quant funds are basically funds that have a completely systematic trading approach. And those funds are few and far between. At the moment, in 2020, there's only 0.01 of the overall managed funds that are quant funds. Interestingly, 4 out of the top 5 managed funds in the world are actually quant funds. And that should get us to think. There's quite a lot of the quant funds leading the list of the active managed funds. And in fact, the only fund in this list that isn't a complete quant fund, Man Group, still has a very strong systematic and quantitative trading approach in many of its portfolio strategies. Now, when we hear quant or systematic fund, we often think about artificial intelligence. But there's a few things to consider when we hear this. It's actually quite a buzzword that helps sell products, and it's not always ideal. Why? Artificial intelligence is still quite immature, and whilst it's really good for recognizing faces, recognizing voices, words, reading text and so on, it's actually not that fantastic for financial markets and many other parts of life. And therefore it is actually a little bit overhyped. Because we have so much AI on our smartphones, we think it's everywhere. But in reality, the AI has really just a small number of strong applications, but there is still a lot that we can wish for that hasn't happened yet. Finally, AI leads quite unexplainable results. So if we have a portfolio that is driven by AI and the portfolio goes well, we'll not question it too much. But if our portfolio goes into a big drawdown, we would really like to know what happened. And AI certainly won't be able to give us the answers. Now, what are the components of systematic or quantitative trading? First of all, we're usually producing a number of trading signals. In the simplest case, this could be moving averages, or this could be some signals that are driven by machine learning and other techniques. Now, once we have these signals, they are converted into probabilities of where our stock price could go with a certain probability or certain, in certain cases, and we use some historical data for that and looking at that. But of course, historical data are not always an indication of future performance, so therefore we have to be really careful, and we're not making any direct predictions. We just say, well, this movement could perhaps go with a certain probability in one direction or with a certain probability in the other direction. Now, once we have these probabilities, based on that we size our positions. So the probabilities provide us with an indication how big our position should be. If we have only a 50-50 chance of going one way or the other, then our position should be a lot smaller than when we have a much higher certainty that the position would go in one direction or the other. But having this probability or certainty doesn't mean it actually does go in one direction or the other. So we still have to be quite careful. And you can see that this is basically an expansion to the coin toss problem that I've shown you at the beginning. And once we have sized our positions, we finally come to execution. And I told you before that sometimes we have firms trying to front run us. When we put a big position on, sometimes we have a great chance to move the market and actually get executed at a worse price than we intended and so on. So good execution can really help us to fine-tune and improve our investment process and save those vital few basis points on every trade, which will pay great dividends in the long run. Now, what are the conclusions of my talk? Basically, systematic investing has been shown now to outperform traditional methods if it's done really well. However, it is complex and difficult to implement, and therefore it is not very widespread at this point. But it does gain increasing traction due to its success. Now, with the move from initially open outcry markets to trading on screens and the disappearance of those open outcry stock markets, to now algorithms mostly dominating the stock market, the trajectory for active investing is also easy to predict. Thank you for listening. Please let me know if you have any questions.